I believe investors are oftentimes caught up with the nitty-gritty of investment securities analysis. How did the company do in the previous earnings quarter? What's the most updated stock's intrinsic value? How is the technical charts looking? Etc. etc. I believe all these are important questions that need to be answered. But I think it is equally important to take a step back and to understand why we are doing what we're doing. Here are three charts that changed the way I saw investing and personal finance. So this first chart is the golden formula to financial freedom. It essentially draws out the relationship between your savings rate versus your investing rate of return. So these two F words, financial freedom, yeah, not any vulgarities or profanities. But financial freedom as a concept has taken many shapes and forms over the years. And many people have came up with very creative definitions. To me, I think it's rather simple. When your passive income is more than your basic and most necessary expenses to survive, you are financially free. And this chart, very simplistically, weighs the three most important factors in this financial freedom equation. How much money do you need to save from your income? What is the rate of return you need to achieve? And what is your withdrawal rate at the point of retirement? And to not go into the specifics, we use the conventional theory of a 4% safe withdrawal rate. Don't ask me why, but there's enough study and literature behind it. Which basically means that your retirement portfolio can generate 4% per year for your own consumption. And this is the range of timeline that you need to work with to work towards your ideal retirement. Intuitively, if you have a high savings rate and a high rate of return, you can achieve financial freedom rather quickly, as denoted by the green areas. However, I think the more interesting takeaway is this. So when you try to pitch the two different factors against one another, savings rate versus investment rate of return, one is clearly more impactful than the other in terms of trying to shorten the time towards financial freedom. So you will actually realize that if you have a relatively low burn rate, meaning your proportion of your spending is a lot lower compared to your income, resulting in a high savings rate, that area of the graph is a lot greener, regardless of whether you have strong investment acumen and have high returns on investments or not. So if you're saving 80% of your income with a 1% rate of return, you'll reach financial independence in 6 years. Saving that same 80% with a 20% per annum rate of return, it only shortens the timeline by 1.5 years. On the flip side, if you're only saving 20% of your income and have a 1% rate of return, take a guess. You'll need 69 years. And even if you're Warren Buffett, the goat of investing, with 20% CAGR per annum, you'll still take 16.7 years. And I believe at the end of the day, why most people invest is to eventually make more money. And why do you want more money? It's to have more options. And in short, having more options just means that you have much more freedom to give the middle finger to anyone. And although in the marketplace, we glorify investing, making your money work harder for you, etc., sometimes we do need to keep tabs on our own spending habits, and the quickest way to achieve any level of financial freedom is to have an extremely high savings rate. And conventionally, you can do it via two ways. You literally scrimp and save and cut back on everything, or you can find other ways to increase your income. So for those of you looking to trade US stocks affordably, Phillip Capital, one of the region's top brokerage firm, has just made that a reality. Zero platform fees, no hidden charges. You can now trade US stocks at an 88 cents USD flat rate. So the best part, they've also recently offered US fractional shares trading on Poyum's Mobile Tree app and Poyum's 2.0 desktop version. So you can now invest in your favorite stocks at a fraction of the share price. And to top things off, new users to Poyums can now enjoy welcome gifts worth up to 1,000 Singapore dollars. Open an account with Poyums to enjoy 0 US commission trading for 90 days, 0% sales charge on unit trusts, and free live prices. And if you make an initial deposit of at least 10,000 Singapore dollars within the first 14 days and execute at least 5 buy trades, you will also get a free Google and a free Bank of America share. You can also trade CFDs to receive more rewards, and this promotion ends on the 30th of August 2024. Furthermore, you'll get free live trading view, a library of asset classes, including unit trust, CFD, robo-investing, and equities, on-platform stock analysis, and even educational webinars, all within the Poems Mobile Tree app. So for those looking for an affordable solution to buy US stocks, you wouldn't want to miss this out. Act fast, as the welcome gifts offer will end on the 30th of June. So all the links will be in the description box down below. Now, the second chart is an important lesson about the power of compounding. So look at the net worth growth trajectory of the investing legend himself, Warren Buffett. And Buffett is well respected in the community for producing spectacular investment results. But here's the kicker. He's not a legend because one of his investments did a 10x or 100x return. I'm sure he did with Coca-Cola and even Geico. He's a legend because he was able to do 20% per annum for 58 freaking years. Many, often new to investing, would think that 20% returns per year is child's play. I can probably do 20% in 2 weeks. But the focus is always on how sustainable your strategy is in delivering the optimal returns. And there was a famous legend about rice and chessboards. So a long time ago, the inventor of chessboard, allegedly, showed it to the Emperor of India. And the Emperor was so impressed by the new game and wanted to reward the man. And the man cheekily replied that his wishes are simple. Give me 1 grain of rice for the first square of the chessboard, 2 grains for the next square, 4th for the next, 8th for the next, and so on and so forth, until all 64 squares of the chessboard is filled, with each square doubled from the previous. And the emperor, without much thinking, agreed, amazed that the man asked for such a small reward. And after a week, the king realized that he was unable to fulfill his promise, because on the 64th square, the king would have had to put more than 18 quintillion grains of rice, which is equals to about 210 billion tons, sufficient to cover the entire territory of India with a meter thick layer of rice. And remember, 99% of Buffett's wealth was earned after his 50th birthday. And last but not least, the third chart is around this idea of risk. So traditionally, when we're introduced to the concept of risk, we often believe that risk and reward are inseparable. They're joined by the hip. High risk, high reward, right? Yes and no. When I went for further studies for my undergraduate in business school, academics actually settled on volatility as a proxy for risk. Meaning, the more volatile something is, the riskier it seems. Intuitively, it kind of makes sense. So Tesla, it's a volatile stock. McDonald's is a lot more stable. That's why the conclusion is Tesla is much more riskier than McDonald's. The logic checks out. Okay, bye. But is that really the case? Furthermore, the function of volatility is backward-looking in nature. You can only draw these conclusions after the price action of the stock has taken place. How do you know that moving forward from here, the two things that you are essentially trying to compare will walk down the same path or walk down the same price action? What if, in an alternate universe, Tesla is less volatile than McDonald's in the coming 10 years? Therefore, when you make the conclusion solely based on volatility as your benchmark, you can only make conclusive statements after the fact. And from this point onwards, you can't make an accurate judgment into the future because you just don't know how the two will perform unless you can see the future. Therefore, this third chart from Howard Marks's 2006 memo defining risk is probably much more accurate. Riskier investments are those where the outcome is less certain, not because it is more volatile. And this just means that the probability distribution of the outcome is far wider, and you can't determine accurately how it would play out. Therefore, it is true to a certain extent that riskier investments should entail higher expected returns to essentially compensate the person for this uncertainty. But it also means that there is a larger probability of both lower returns and even cases of losses. So the next time when you hear people say that riskier investments provide higher returns, and if you want to make more money, the answer is simple. It's just to take more risks. I think you should run away from them. Because riskier investments absolutely cannot be counted on to deliver high returns. Why not? It's simple. If riskier investments reliably produced higher returns, they wouldn't be riskier. And this is basically Howard's perspective. So I hope that these 3 charts stay with you for the rest of your investing journey, and I wish you all the best. So I'll see you in the next episode, but more importantly, I'll see you on the moon. Goodbye.